Massive deflation, massive changes to my expectation for when the housing market is going to bottom, massive changes for household formation. We have so much to talk about in this video. It's crazy. Just remember, we have extended the coupon code for the real estate investing course, do-it-yourself property management course, and the other courses like the real estate agent course or stocks courses until December 14th at 11:59 p.m. You get lifetime access to those programs on building your wealth, new lectures coming out this month, lifetime access to when I conduct the live streams. You have access to those anytime I go live, the private course member live streams where we do deal analysis as well. So make sure to check those out, link down below. It's the sponsor for this video. Huge shift in rental inflation could mean a massive change to real estate projections and the real estate collapse projections that might not end up leading to a collapse. In fact, the buying opportunity for real estate could be shifting up, not back. Let's talk about all of that and more in this video on real estate investing. Let's get started. First, this morning we had the CPI report, the Bureau of Labor Statistics Consumer Price Index Inflation Report. And what's very important here is to pay attention to something that has substantial lags. Rental shelter, specifically right here, owner's equivalent rent of residences. This is basically where the Consumer Price Index and the Bureau of Labor Statistics try to estimate, hey, how much are properties worth on the rental market? And so what they'll do is they call owners and survey them, hey, how much rent do you think you can get for your property? The problem with that is when rents start going up, owners don't actually realize that. And so you don't realize those rents going up until much later. You have to shift that over when you realize that, probably by about 6 months, are the estimates at least JP Morgan and Goldman Sachs agree on. So the problem with this is rental inflation makes up about 32% of CPI and about 25% of PCE. That's basically the Fed's version of CPI. The point is, owner's equivalent rent and rent to shelter makes up a huge component of inflation. And if the data they're using is 6 months delayed, then they could be making some big mistakes if all of a sudden rental inflation is plummeting, but it takes 6 months to actually start seeing that rental inflation plummet over here. Now, the good news is, Jerome Powell has already made it clear they're astutely aware of this decline delay, and as long as they continue to see this decline trending down, they will assume that this decline will come, which is good because it means you have a Fed that, even though they're kind of looking in the rearview mirror, they are looking at current data as well. And that's what we're going to look at today, because here's the thing. When you jump over to the owner's equivalent rent, you actually see it's up 0.7% month over month. That's a lot. That's 8.4% on an annualized basis. Not great, but remember that. Keep that in mind. I want you to keep in mind 8.4% because we're going to compare that to something in a moment. Overall shelter inflation was 0.8%. That's 9.6% annualized. Not great. Now, we did have some declines in hotel and lodging. Look at that. Lodging away from home, specifically hotels and motels, declining on the month-over-month basis right here, which is actually incredible. I actually think it's going to contribute to what we'll see as an Airbnb collapse, where more people are renting out Airbnbs because they need more money, but less people are actually demanding them because they have less money. And so you end up seeing a large, unfortunately, in both directions, movement in prices basically for Airbnbs and rentals and hotels going down. That all helps take shelter inflation down. Add to that a decline in owner's equivalent rents as we look at new lease signings. Oh boy, you're setting up for a massively deflationary environment and potentially quite large cuts at the Federal Reserve. So what do we have today? Well, look at this, folks. Asking rents post the smallest annual increase in 15 months in November. Look at some of the data here. And I'll tell you, there's one area that is still booming in contrast to the trend. It's just one area based on these surveys. And I'm going to tell you exactly what area that is. It's a certain state. I want you to start thinking about what state actually has their rental increases going in a complete opposite direction as anybody else. In other words, where are rents still going up, right? All right, so what do we got here? If you look at the average of the United States, median U.S. asking rents climbed 7.4% year over year to about $2,000, $2,007 in November. This is the smallest increase in 15 months and the 6th month in a row where annual rent growth slowed. Now, I want you to think about that for a moment, because you might look at that and say, hey, well, rents still went up 7%. How is that a good thing? Well, remember how this works. When you have rental inflation because of a pandemic that booms like this, and then you have an inflection point like this, the way this year-over-year comparison works is really kind of funky. Because if we're over, let's say, in December, right, and we're comparing to December of last year, we might be right here right now where the green is. This might be where we are right now. And when we look at December of last year, well, December of last year could actually be over here. And so now when you compare these, you're actually still up. You're still up from last year, but the trend is plummeting. And this is why when you look at more recent comparisons and you go, well, wait a minute, when we compare this area up here, or I'll use orange, when we compare here to, let's say, here, the change is huge, right? Because you're only measuring on the upslope. Now you're actually measuring the downslope compared to the upslope, and you're having less of an increase. And soon this will turn negative because this is the trend we're going in. So that's why you still see those year-over-year gains. It's only been about 6 months of these going down, so give it another 6 months and then we'll see year-over-year declines. And all these numbers will be negative. That'll be pretty glorious because it's also going to affect real estate valuations. And towards the end of this video, we're going to talk real estate valuations a little bit, especially since lower rents could lower cap rates. But how is it possible that we have lower rates if that means, if there are less homes? Talk about that as well. So, very interesting. Slowing inflation could lead to lower mortgage rates. We'll touch on that a little bit later as well. By comparison, rents were up twice as much in the summer as they are now. Rents were up about 15% versus the about 7.4% where we sit now. But what I want you to see is this. This is remarkable, okay? These are the largest, out of the top 50 cities, these are the largest declines in month over month. Actually, these are year-over-year asking prices. Let me double check that though. These are, median asking rents year-over-year. So the largest declines over here were Milwaukee, Austin, Houston, Baltimore, Minneapolis, Chicago, Denver, Atlanta, Dallas, Jacksonville, Boston, Los Angeles, Vegas, and New Orleans. Now, what's interesting here is I compared this rental survey to May, and I wrote it right here. And everything in green highlighting means that today rental inflation is slowing compared to May. So for example, Milwaukee was down 10% year over year in May, now it's down 13%. So in other words, we're still trending down. Houston was up 16%, now it's down 6%. Austin was up 48%, now it's down 5.3%. You could see this crazy arc happening in some of those boom towns like Austin and Houston. Crazy arc. Chicago, for example, was up 6%. Now it's down 3.8. Denver was up 16. Now it's down 2.9. Atlanta up 18, down. Dallas was up 21, now down, right? So you see this. There's only one place, and these are declines. There are those still areas where rents are still going up year over year. However, I've highlighted in green to show you how those are also declining. Now, this right here shows you cities where rents are still going up. But what I do is I compare this to May. And if this number right here is smaller than the May number, what I'm about to show you, it suggests that rents are starting to fall in these areas as well. So these are still positive year over year, but they're also starting to slow down. So for example, Indianapolis, it grew at 15.8%. Well, in May, it was growing at over 20%. Now, I'm going to zoom out. And in green, you're going to see where rent inflation is slowing. In pink, you're going to see the one state that has two cities where rent inflation is actually getting worse. It's the only one out of this entire survey where things are getting worse. Ohio, folks. Ohio. Cleveland, rents in May up 9.6% year over year. Cleveland now in November, up 14.9%. So you actually have rental growth where everybody else is declining. Ohio, at least Cleveland, is going up. Columbus was almost stable. So even though this number is a little smaller, I marked it as pink because it's almost stable. They're at 8.4% now versus 9% earlier. That's not true for Cincinnati, though. Cincinnati's down to 9.2% versus the 31% they had previously, so a big deceleration there. But for some reason, Cleveland and Columbus are holding up. And that's quite interesting, how those are the only ones holding up. Everyone else is declining relative to the growth rates we've seen earlier in the year. And this is why when you look at the average growth rate is about 7.4%, which, remember, the numbers we wrote over here on the BLS report, you're at 9.6% annualized rates of growth for the CPI, the CPI report, right? 9.6%. The rent tracker is telling us we're actually at 7.4% and declining fast. This number is likely to go negative. When this number goes negative, 6 months later, these numbers over here go negative. Oh my gosh, we are going to have a 30% anchor on inflation. Massive deflation could be coming because of this kind of shelter deflation. So let's think about this for a moment, because real estate values are based on how much cash flow you could get, right? How much you can earn from investing in real estate. And when rents go down, cash flow goes down, and cap rates, go down. Cap rates are your expected capital return on a property, right? So you take your gross rent, you take off your expenses, how much is less divided into the price, you get a rate. California is like 2 or 3% often. Florida might be 5 or 6%, right? And so different areas have different cap rates. Problem is, when rents go down, those cap rates go down and valuations come down. So what's really interesting here is, even though mortgage rates are trending down and more people are renting, rents are trending down. Now that's fascinating, because how could more people be moving to renting rather than buying, but rents be moving down? It has to do with household formation. The housing market right now is not in a place where a lot of people feel confident, and the broader economy is not in a place where a lot of people feel confident about their own finances to form households. So as older folks potentially retire and move in with family and sell properties, you're putting more inventory onto the market, or they're passing away, more inventory is going on the market, but less people are buying those homes. Less landlords are buying those homes. But in addition to that, you potentially also have fewer younger families like Gen Zs or millennials, like deciding to move out of their family homes because you're in tough economic times, so you have less actual rental demand. And this is how you could actually see both rental prices move down and home prices move down. It's sort of the end part of the inertial inflation part. See, initially, earlier in this year, when you start raising rates, you actually tend to push rates up because the people are like, okay, we're definitely forming a household, we're gonna buy, now we're gonna rent, right? So you push up rents. That's part of why we've seen some crazy rental inflation earlier in the year, because people are like, that's it, I'm done, I'm not gonna buy. Once that's over, people are like, I'm just not gonna form a household. Now you have less household formation. What happens? Less demand for homes for sale, less demand for rentals. Less demand for rentals means even as mortgage rates come down, you could actually see valuations on homes potentially start sliding down because they're much less attractive to institutional investors or even mom and pop landlords, putting less competition on these homes. And home buyers are now fearful about a potential downtrend in real estate. And so even though lower rates from the Federal Reserve, or even just the market, the mortgage market, I'll talk about that in just a moment, could suggest more affordability for homes, you're still walking into a really uncertain time, which doesn't necessarily say the bottom's in for real estate. In fact, I don't think it is. I'm going to talk about that in just a moment. But let's quickly touch here. What are bonds doing? You look at the 10-year Treasury. The 10-year Treasury is down 14.6 basis points after the inflation report today. That should really drive mortgage rates down. I believe mortgage rates right now are around 6.3%. Let's just go ahead and type in mortgage rates. Let's pop this onto the 740 credit score. We're always going to use the same credit score. Okay, so they're sitting at about 6.7 after today's Treasury movement. I expect this to go down to 6.5, 6.4, right around there. So we'll see, give this a couple days for markets to adjust. We'll probably see mortgage rates around 6.5. And if we continue trending in this direction, we could be around 6% mortgage rate soon. That, though, however, is still 3.5% higher than where we were in December, which still removes 35% purchasing power from buyers. Rule of 10x. The real problem there, though, is less household formation, 3.5% higher mortgage rates, combined now with the fear is, in my opinion, going to keep home buyers out of the market for longer. Because one of the factors you look at when you go buy a home is, what can I rent this out for if I needed to? Well, now those rents are starting to slide. It's going to create fear, and I think a big buying opportunity for real estate. Now, let me give you some timeframes. My opinion, my expectations. Obviously, I run a company called House Hack. It's a real estate startup where we expect to buy rental properties. So the rapid decline in inflation and these deflationary signals, in my opinion, move up the time to buy real estate. That time, though, is not now. Even though we're seeing these sorts of declines in mortgage rates, the time is not now. I think that time is really lining up for Q2, Q3 of 2023, especially if we continue on this disinflationary trend. I'm going to explain why. Remember how earlier I said year over year we're going to start seeing negative rental inflation, and that's going to be really disinflationary, right? Or deflationary? It's also going to create panic, in my opinion, because you're not only going to see year over year home prices negative, but you're going to see year over year rental prices negative. So in other words, why would you buy something that's plummeting in value? Why would you buy something where your safety net is also plummeting in value, being able to rent out the property? Most people won't. And that's when you get around peak fear for real estate, and it potentially becomes the best time to buy, especially if the Federal Reserve moves into the territory of a Fed U-turn and we actually see them start slashing rates, which I actually expect massive rate cuts within the next 12 months, because I think shelter inflation is going to anchor overall inflation down heavy. So my thoughts: check out the programs on building your wealth, get prepared for this real estate transition. Use that coupon code link down below, and folks, we'll see you in the next one. Thanks so much. Goodbye.